Hello, everyone. Thank you for joining me today. I'm really excited to walk you through what I consider to be three of the smartest stock trading strategies for those aiming for significant gains in the market. Before we dive into all the details, I want to remind you that I'm not a financial advisor and none of this is personalized financial advice. I'm simply sharing insights and strategies that I have researched and found effective, and I hope these ideas will help you deepen your understanding of the market. Always make sure you do your own research and, if necessary, consult with a qualified professional before making any investment decisions. That said, let's get started by looking at the big picture of why strategies matter. A lot of new traders jump into the market without a clear plan, hoping to make quick money, and while there can be exciting success stories, the harsh truth is that without a well-defined, disciplined strategy, the risk of losing money increases dramatically. A smart trader needs to align their strategy with their goals, risk tolerance, and time frame. Some people want fast trades that last only a few minutes or hours, while others prefer to hold on to positions for days or weeks, and still others are comfortable with months or even years. All of those approaches can be valid. The key is understanding which style suits you best and applying it consistently. That's why I want to share with you three of my favorite strategies. They can be used by both beginners and experienced traders, depending on how carefully and consistently they're implemented. So if you stick with me, I'll walk you through how each one works, what you need to watch out for, and how you can manage your risk along the way. First, let's talk about the mindset and overall approach you should have whenever you trade stocks. It's not just about diving into a strategy and applying it blindly. You also need to understand that every strategy relies on probabilities rather than guarantees, and that means you need to be prepared for losing trades. It's inevitable. The difference between successful traders and unsuccessful ones is not whether they lose money, it's how they manage those losses and keep them smaller than their gains. That's why you'll often hear about concepts like risk-reward ratio, position sizing, and stop-loss orders. These tools and principles help you mitigate losses when the market doesn't move in your favor. Additionally, patience and discipline are key. If you can't keep your emotions in check, greed, fear, impatience, you might deviate from your strategy and make impulsive decisions. Another often overlooked aspect is that the best trading strategy for you might be the one that fits your personality. If you're someone who finds it stressful to sit in front of a screen all day and monitor every fluctuation, then maybe ultra short-term trading is not right for you. Conversely, if you thrive on quick decision making and fast execution, you might love active intraday strategies. So as I describe these three strategies, think about not just which one sounds the most profitable, but which one aligns with your temperament, your schedule, and your level of commitment. Let's begin with what many people call momentum trading. Momentum trading is built on the principle that stocks that have been moving strongly in one direction, usually upwards, tend to keep moving in that direction for a period of time. The idea here is to capitalize on that strength. Momentum traders look for stocks that have high trading volume and are experiencing strong price movements, often driven by positive news, earnings beats, new product announcements, or general market excitement in a sector. If you spot a stock that has gapped up significantly at the market open because of good news, that might be a candidate for a momentum trade. However, you don't just jump in blindly. A typical momentum trader will look for a confirmation. Perhaps the stock holds its gains for a certain amount of time, or it breaks above a key resistance level on strong volume. If it does, they might buy shares with the expectation that the upward trend will continue. The key to success in momentum trading is timing and discipline. You have to watch for signals that the momentum is fading, such as a drop in trading volume or the stock failing to break through another resistance level. Many momentum traders set tight stop-loss orders so that if the stock reverses, they exit quickly, minimizing their losses. On the other hand, if the stock continues to power upwards, a momentum trader might hold on to the position for as long as the trade remains strong. The greatest challenge with momentum trading is that it can involve a lot of volatility. You might buy a stock, see it move up nicely for half an hour, then watch it suddenly crash if negative news hits or if the broader market weakens. That's why momentum trading often requires quick reflexes and the willingness to exit at the first sign of trouble. It also tends to be more short-term in nature. Sometimes you might hold a momentum trade for a few hours or a few days, but rarely for months at a time, because the core premise is that you're riding a wave of strong movement and want to exit when that wave subsides. Some traders use technical indicators like the relative strength index or moving averages to gauge whether a stock's momentum is still intact, But no matter what tools you use, the principle remains the same. Get in when the stock is hot and get out before it cools off. The second strategy I want to discuss is swing trading. Swing trading typically has a slightly longer time horizon than momentum trading, often ranging from a few days to a few weeks. The goal here is to capture swings in the stock's price. A swing trader might look for a stock that is consolidating and appears ready to make a significant move up or down. Sometimes this can be identified by chart patterns like triangles, flags, or channels. For instance, if you see a stock that has been trading within a well-defined price range, and it suddenly breaks above the upper boundary of that range, that can be a powerful signal that the stock's price might move higher for a few days or weeks. Swing traders use both technical analysis and fundamental catalysts. From a technical standpoint, they'll watch moving averages, support and resistance levels, and momentum indicators. From a fundamental standpoint, they might look at earnings reports, product launches, or macroeconomic factors that could influence the stock's price over the next few weeks. Once they identify a high probability setup, they'll enter a position. The benefit of swing trading is that it doesn't usually require being glued to your screen all day. You can often plan your trades by scanning charts in the evening or early morning, set your entry and exit points, and then monitor your positions for the next several days. In this sense, it can be more relaxed than very short-term momentum trading or day trading. However, risk management is still critical. Swing traders need to decide on a stop-loss level, perhaps just below a key support line, so that if the trade moves against them, they don't sustain large losses. They also need to determine profit targets, or at least have a system for scaling out of their position if the stock moves up. For example, a swing trader might plan to sell half of their position after a 5% gain and let the other half ride for a 10% gain, setting a trailing stop loss to lock in profits. This partial exit method helps balance risk and reward. The beauty of swing trading is that it offers flexibility. You're not forced to act within minutes, and you're not holding for extremely long periods of time where you might be exposed to bigger market swings. Instead, you're looking for manageable moves in the stock, capitalizing on short-term to medium-term trends. Now, the third strategy I'd like to share is position trading with a focus on value and growth. While it might be less flashy than the other two, it can often lead to substantial gains if executed properly and if you have the patience to let a position mature. Position trading, in essence, means you're holding a stock for a longer time frame, often months, sometimes years, based on a strong conviction that the company's fundamentals will drive its stock price higher over the long run. This approach can involve value investing principles, where you look for a company that's undervalued by the market, with a low price to earnings ratio, healthy balance sheet, strong cash flow, and other metrics indicating it's trading below its intrinsic value. Alternatively, it can also involve growth investing principles, where you look for a company poised to expand rapidly, perhaps because it's in a fast-growing sector like technology or biotechnology, or because it has a game-changing product. Position traders often pay close attention to fundamentals, revenue growth, profit margins, competitive advantages, and management quality. They might also watch macro trends. If the entire sector is growing rapidly, that can be a tailwind for the company. While technical analysis isn't completely ignored, it often takes a back seat to long-term fundamentals in this approach. The key is to identify a stock that looks promising for the long haul. Once you buy, you hold and let time do its work, provided your investment thesis remains intact. But this doesn't mean you simply buy and forget about it. Position traders still keep track of news, earnings calls, and changes in the company's business model. If something fundamentally changes, say the company's key product flops or its competitive landscape shifts dramatically, you might decide to exit earlier than planned. And if the stock's price runs up to a level that seems overvalued, you might trim your position or exit entirely. In terms of risk management, position traders often rely on diversification and fundamental resilience. Because you're not trying to time the market perfectly and jump in and out every week, you accept that the stock's price might fluctuate. The big moves can be to the upside if your thesis proves correct, so it's important not to get shaken out by short-term volatility. That said, it's also crucial not to hold on to a losing position out of sheer stubbornness. If the fundamentals truly turn sour, you need to revise your thesis and possibly cut your losses. This strategy is particularly appealing to those who prefer a more laid-back approach. It requires less daily monitoring, but it demands a solid understanding of how to evaluate a company's true worth and potential. Now that we've covered those three strategies, momentum trading, swing trading, and position trading with a focus on value and growth, Let's talk about how to decide which one might suit you best. One factor is time. If you can't or don't want to monitor the market frequently, position trading might be the best fit. If you have a decent amount of time to scan for setups in the evening or on weekends and can manage trades during the week without constantly checking your screen, swing trading can be great. If you love the thrill of quick moves and have the emotional discipline to cut losses fast, momentum trading might be for you. Another factor is temperament. Momentum and day trading can be stressful because they involve rapid fluctuations and quick decisions. Some people thrive in that environment. Others might find it nerve-wracking. Swing trading and position trading can be less frenetic, but require patience and the ability to handle market volatility without panic selling. Also, consider your capital. While you can start with a modest account in any strategy, some brokers require a minimum balance for frequent day trading due to regulations like the pattern day trader rule in the United States. Swing trading and position trading often have fewer restrictions in that regard. Risk management remains crucial regardless of which strategy you pick. Always plan your trades with an exit strategy in mind. For instance, if you're a momentum trader, set a stop loss below a recent support level or below the breakout point. If you're a swing trader, determine how much you're willing to risk based on the stock's volatility and your position size. For position traders, consider how each holding fits into your overall portfolio balance. Avoid putting all your eggs in one basket, no matter how promising a stock might seem. Emotions can run high when you're trading. Greed might tell you to hold on to a soaring stock way too long, only to watch it dip. Fear might force you to sell prematurely, or skip a trade entirely, even though it meets all your criteria. Discipline is the name of the game, and if you find yourself consistently sabotaging your strategy, you might need to take a step back and reevaluate. Keeping a trading journal is one effective way to refine your approach. In that journal, jot down the reasons you entered a trade, the price at which you entered, your exit strategy, and the outcome of the trade. Over time, you'll notice patterns in your behavior and results, and you can adjust accordingly. Maybe you'll discover that you do better with swing trading than short-term momentum trading, or vice versa, or perhaps you'll see that your losses stem from not honoring your stop-loss orders. The more data you have on yourself, the better you can optimize your approach. Let's also address the concept of studying the market. Whether you're adopting momentum, swing, or position trading strategies, it pays to keep learning. Staying on top of market trends, sector performance, and economic indicators can give you an edge. For momentum trading, you want to know which stocks are likely to surge based on daily news or catalysts. For swing trading, you'll want to follow earnings calendars and watch for upcoming announcements that could spark a multi-day move. For position trading, you'll be keeping an eye on the broader economic cycle and looking at the company's fundamental growth drivers. Don't underestimate the power of fundamental analysis, even if you're primarily a technical trader. Sometimes a quick glance at a company's earnings growth or debt levels can save you from a bad trade, even if the chart looks decent. Another important aspect is risk tolerance. Momentum and swing trading, by their nature, can involve more frequent trades. That can lead to more commissions or fees if your broker charges them. Although many brokers now offer zero commission trading on stocks, still each trade carries risk, and if you're not careful, you could rack up losses quickly. With position trading, you make fewer trades, but each trade is a longer commitment, so you're exposed to whatever the market does during that time. If you're truly uncomfortable with short-term fluctuations, you might find momentum trading too stressful. On the other hand, if waiting months for a payoff feels tedious, you might be more drawn to momentum or swing trades. Once you've chosen a strategy, it's often wise to test it out with a demo account or with a smaller portion of your capital before committing large sums of money. This way, you can practice setting up trades, placing stop-loss orders, and observing how the market moves without risking everything. You'll also get a feel for whether you can stick to the rules of the strategy without letting emotions override your plan. Don't be discouraged if you don't see instant success. Trading is a skill that takes time to develop, and even after years of experience, you'll still encounter losing trades. The goal is to ensure that your methodology yields more gains than losses over the long term, and that you consistently learn from your mistakes. A good rule of thumb, no matter the strategy, is to never risk more than you can afford to lose. This might sound obvious, but it's easy to get caught up in the excitement of a hot stock tip or a strong breakout, only to realize you've over-leveraged your account. By maintaining proper position sizes and stop-loss orders, you protect your account from catastrophic losses. This helps you stay in the game longer and eventually find those winning trades that can significantly grow your capital. Always remember that you can't control the market. You can only control how you respond to it. Let's briefly recap these three strategies in practical terms without labeling them as sections. If you love the idea of quick trades and have the time and emotional resilience to handle rapid ups and downs, momentum trading might be your go-to method. You'll be scanning the market for stocks that are surging on high volume, entering quickly, and exiting just as fast if the stock shows signs of reversing. If you prefer a slightly slower approach, where trades last from a few days to a few weeks, and you like analyzing chart patterns and fundamentals, swing trading may suit you well. It strikes a balance between active trading and more relaxed timeframes. Finally, if you have the patience to hold positions for months or even years, based on deep fundamental convictions, position trading with a value or growth focus can be incredibly rewarding. Although it does require a solid understanding of how to evaluate companies and the willpower to endure fluctuations. Whichever path you choose, stay disciplined, keep learning, and remember that consistency is the ultimate key to success in trading. I want to leave you with a final thought. While these strategies can offer pathways to substantial gains, they are by no means a guaranteed ticket to easy profits. The market is unpredictable, and even experienced traders face losses. What separates the successful traders from everyone else is that they stick to their strategies, manage their risk carefully, and constantly adapt. They don't chase every tip or rumor. They respect the market and approach it with humility, knowing that they can't control it, but can only control how they participate in it. If you can adopt that mindset, along with a solid strategy that matches your goals and risk tolerance, you'll be far more likely to achieve the kind of results you're looking for. And remember, it's a journey. The best time to start learning is right now, and with consistent effort, you'll refine your approach and grow not just your trading account, but also your understanding of how financial markets really work. Thank you for joining me on this overview of 3 powerful trading strategies, and I wish you all the best in your trading journey.